We have covered the meteoric rise of equities over the last 5 or 6 weeks off those March lows from a couple different angles the past few weeks. But we wanted to bring back one from maybe just 5 or 6 weeks ago because the picture has changed dramatically during that period. So we talk about relative strength. If you're not familiar with that or don't remember what we talked about, it's where you take a look at today's price and look at it versus various moving averages to see if we can learn any sort of pattern with this. So specifically a 50-day moving average, 100-day, and 200-day. And the idea is if you see it in that order with the price above the 50, above the 100, above the 200, that usually shows strength in a market. And depending on how that pattern looks, is it overbought or is it just a strong trend? And we'll cover that in just a second. The inverse is true as well. If we see the price below the 50, which is below the 100, which is below the 200, we see a market that's sold off pretty strongly. And often there's room for that market to rally because prices have maybe moved a little too far relative to what a market pricing or a fundamentals may say. So we'll pull our first chart up here. And this is the S&P 500. And this is the chart that we actually showed about 5 or 6 weeks ago. And if you look to the right there, we showed it to you when the blue line fell all the way down below all three of them. We noted at that time that this wasn't a classic oversold level because we didn't have that kind of stack in perfect order. So things had moved kind of rapidly. We then rallied immediately back out of it. And as you see there on the right, we've spiked well above all three lines. But in the same token, it's happened so fast, we haven't even reset the pattern yet. The 50-day isn't above the 100-day moving average yet. So a couple things that we look at here, you see periods where that stack is pretty consistent with the blue on top and it stays pretty close to those averages and kind of grows with the lines together and the averages. That happens fairly frequently and doesn't always indicate a pullback is imminent. We saw that in the late 90s. We saw that coming out of 2008. We saw that coming out of COVID as well. So these, this can persist. But when we see spikes like we see on the one on the right-hand side, it is, concerning is the wrong word, but it definitely is worth noting, I think is probably a better way to say it. If we drill down, where's this coming from? I don't think this is a surprise. The next slide, here's the IT sector. You see the exact same pattern. And we've joked about technology driving the market. In fact, in all these charts that are as of the end of last week, as of Friday's close, last week, the technology sector drove 105% of the return of the S&P 500, meaning that the other 10 sectors pulled it down by 5 to get you back to 100, right? So the math works. So literally, it drove more than the market last week. And if we want to figure out where that actually came from, it came from semiconductors, which is our third chart here. And you see that exact same pattern, even a little bit more extreme. So how do we put this into context? Because sometimes it's hard to look historically, price levels grow and a 1% move today is more, at least in an index price level basis, than it was 10 or 15 years ago. So the last chart will show you basically puts this on an even playing field. So we're looking at percentile rankings. Basically, we take these moves and we look at how they rate relative to other moves throughout time. And you see 3 stacks of bars. So on the left, we see today's price versus the 50-day moving average, again, since 1990. What are those percentiles? In the middle versus 100, and on the right versus 200. So if we focus on the left there, you see the S&P in blue, IT in gray, and the semiconductor sector in white. You see that regardless of where you look, we're really in the top 1 to 1.5% on a price basis versus the 50-day moving average. So we're kind of in rare air. And I think we all know this, and we've said it repeatedly in the past. There are no guarantees in investing. There are no certainties. We invest based on probabilities. So if we lay this out in front of you and say, our current price, things have only been better versus this 50-day moving average 1% of the time, odds are not in our favor, to adapt a famous phrase from a movie. And it's worth noting. So again, are we predicting some sort of cataclysmic pullback? No, is the answer to that. These trends can persist. But if we're investing based on probabilities, the index is moving very rapidly based on some of these huge price moves. Your portfolio probably is as well, and it's worth taking a look and making sure you're positioned in a way you're comfortable with and you're positioned in a way that fits your risk tolerance. So it's a great time to rebalance and evaluate if you need to rebalance. And then let's look for that pullback because they do happen pretty frequently. And then we have another opportunity to maybe build some more weight in some of these areas that have run really far, really fast. So thanks for your time today.